everyone's on the side of up and to the right, and bad news is rarely greeted with open arms by anyone. And Silicon Valley was this a big rock candy mountain. We had a bearish piece on it in 2019, and Bill said that it was down a quick 20%. Yeah, ours stock tripled after we wrote about it for the next couple of years. Deposits, as he said, doubled over the course of like 18 months or even less. What I would add to Bill's analysis is there was a big loan portfolio as well. It's not just securities. And these were, I think, in good part loans to venture capital and startups and founders, as that word is now thrown around. And it's the 70 billion is 73 billion, I guess, is much larger than book equity. And what 0% interest rates do is bring on the phenomenon of zero gravity finance. Imagination displaces analysis. And if you are in the business of projecting technology out into the wonderful 10 or 20-year realm, there is nothing like 0% rates to facilitate that exercise in imagination. And that's what Silicon Valley Bank had going for it. So this portfolio, $73 billion loan portfolio, I think, might also have been problematic.
So quickly then, before I know we want to broaden this out, but when you look at the response and the rhetoric, are we understanding the vulnerabilities in other banks and the rest of the banking system, or not here?
Yes, well, here is I think is a plain vanilla worry about the banking system. As every depositor knows, what has not happened in the past year or so is a big uplift in the rates one earns on savings balances and checking balances. It's still like 88 basis points or something. So imagine what would happen to net interest margins on banks if that 88 basis points suddenly were translated into a 4% money market rates, which one can get in government guaranteed obligations.
Right.
And so I think what is happening, for example, First Republic, is people are mentally marking to market the net interest margin on that bank. It's not just the credit risk, not just the risk of combustion in the midst of a panic, but rather reimagining the business model in the context of very much higher deposit rates and very much lower net interest margins.
Let me see if I can turn the conversation in the way that I think Kelly was anticipating, and that is this. One of the things that Bill just mentioned was the idea that we had very low interest rates for a very long time. And you point out correctly, having been an interest rate observer, you've observed a lot, man.
I was actually present at the invention.
At the invention of interest rate. The point here is that he was making the point that maybe the management got complacent because interest rate had been so low for so long they couldn't wrap their head around the idea of them not being that way. You point out that now we may be in a scenario where higher interest rates become the new norm, not just for a little while, but for a long while. And what might that mean?
Well, the curious thing about interest rates, unlike almost any other financial variable or price we can think of or market, is they tend to trend over generation
long
intervals, right? So interest rates fell for the final quarter or so of the 19th century. They rose in the first 20 years of the 20th. They fell until 1946. And from 1946 to 1981, they rose persistently, not invariably. But that was when 1981, Kelly, you won't remember this, but in 1981, the long bond got 15% and mortgages knocking on the door of 20. And for the past 40 odd years, rates have persistently fallen. So that's a lot of muscle memory. So you asked Bill, the prescient Bill, what were the component factors of the error? And so I would say that the muscle memory is one of them. Conditioned expectations of falling rates, and also the well-observed pattern of the Federal Reserve to buckle in the face of the difficulties that rising rates brought on at intervals. For example, in 2018-19, you recall the stock market was down almost 20% around Christmas Eve that year, and suddenly Chairman Powell was not going to raise, so that, and then 2019 in the September there was this repo thing, this inside baseball.
But you wonder if we're running through that again. That was the first time we tried to do quantitative tightening. We barely shrank the balance sheet and we ran into a big reserve crisis.
Right.
What are we doing now? We're trying to shrink the balance sheet. What are we get? I don't know if it's exactly the same, but it just doesn't feel like an accident to me.
I I know, I would say that it is part and parcel of that, you know. One of the things I've observed over so many years is that credit seems always want to be more prolific. Credit wants to be more prolific. Money wants to be looser. And you know, people kind of elect inflation. They choose it. They choose it by the government they put in place that spends. And I think there's a persistent inflationary undertow to things that is now coming to the fore.
Let me, I don't know whether this is our last question, but let me ask it nonetheless. Can the Fed fight inflation and manage a banking crisis at the same time?
No. Chairman Powell will tell you that they are doing just that next Wednesday, I think it is, but no, they cannot do that. You know, here already they're saying this was a costless intervention, you know, but notice, and then somebody was kind of saying, Walter Badger himself would have approved of this because they're lending it as no, they are lending at par against securities that are trading well under par, and they are delaying, we suspect, the rate rises that are necessary, we think, to stop inflation, or at least diminish it. So that is a form of a tax, right? That's, everyone's gonna pay for higher, with the inflation
Or
tax.
inflation,
Yeah, so this is another, to me, highly unwelcome intervention to forestall markets doing their thing.
Why don't you think we'll end up in a deep recession because of this? The way that the yield curves and the leading indicators, I mean, it all kind of points to that.
I'm in that camp. I'm not sure about the deep. I said, well, you know, money supply, which was up like a tornado, is now reversed all that. So we have a negatively sloped yield curve, and we have money supply growth falling off the table. Those are two very potent, have been historically very potent indicators of trouble ahead. And so I am expecting opportunity for value-seeking people come the value.
In stock still, or?
Well, yes, there'll be a value reclamation project, otherwise known as a bear market, I think. But make no mistake, nobody knows less about the future.
That's someone who's been through a lot. Yeah. Jim, thank you so much.
Oh, you're welcome. Nice to be here.
Great.
Thank you.
All right, coming up, a ticking